Welcome back to Financial Reality Check, where we cut through the noise and dive deep into the critical decisions that shape your financial future. Today, we're discussing one of the most important choices any business owner can make, selecting the right business entity. Now, whether you're a sole proprietor, LLC owner, S-Corp enthusiast, or C-Corp bigwig, the structure of your business could be the difference between building wealth or watching it evaporate under the weight of taxes and liabilities. Let's break down the pros and cons of each option and why your choice matters now more than ever, especially with the sunsetting of the qualified business income deduction in 2026. Let's kick things off with the sole proprietorship, the simplest and most common form of business structure. It's you, the owner, and your business are one and the same. This is often the first step for entrepreneurs testing the waters because it's easy to set up with minimal paperwork and costs involved. You report your income and expenses on your personal tax return, and you may pay taxes on profits at your personal income tax rate. Now, what are the pros? Well, it's simplicity. No formal business structure is required, which means fewer upfront costs and less paperwork. You also have direct control. You have total control over all decisions, giving you the flexibility to run your business as you see fit. Now, what are some tax benefits? Well, all profits are yours to keep, and losses can be used to offset other income in your personal tax return. Some cons? Well, you have unlimited liability. You are personally liable for all business debts and obligations. This means that if your business runs into trouble, creditors come after your personal assets, your home, your car, your savings. And then there's the self-employment taxes. You'll pay self-employment taxes on your net earnings, which can be a significant burden as your business grows. You also have limited growth potential. Raising capital can be challenging, and the sole proprietor lacks the formal structure that investors typically seek. Now, what about the LLC? The flexible favorite is the LLC, the limited liability company, which has quickly become a favorite among small business owners. The LLC offers the best of both worlds, personal liability protection akin to a corporation while retaining the simplicity of a sole proprietorship or partnership. What are the pros? Well, unlike a sole proprietorship, an LLC protects your personal assets from business debts and liabilities. It also has some tax flexibility. An LLC can choose between being taxed as a sole proprietor, partnership, S-Corp, or C-Corp, depending on what's most advantageous. The default option is pass-through taxation, where profits are taxed once at your personal income tax rate. It's also pretty easy to manage. LLCs have fewer ongoing compliance requirements than corporations, such as annual meetings or extensive record keeping. Now, some cons. Well, there's the self-employment taxes again. If your LLC is taxed as a sole proprietorship or partnership, you'll still face self-employment taxes on your earnings. And there's a little bit of complexity. While easier than forming a corporation, setting up an LLC involves more paperwork and fees than a sole proprietorship. You also have the potential for higher taxes. If your LLC grows significantly, you might end up paying more in taxes than you would under a different structure, especially if you haven't elected to be taxed as an S-Corp. Now, the S-Corp, the tax-savvy strategist. For those who have outgrown the simplicity of an LLC or sole proprietorship, the S-Corp, or S-Corporation, offers a compelling alternative. An S-Corp is essentially a corporation that is elected to pass corporate profits, income, losses, deductions, and credits through to shareholders for federal tax purposes. Now, what are some pros? Tax savings. One of the most significant advantages of an S-Corp is the ability to pay yourself a reasonable salary and take the rest of your earnings as distributions, which aren't subject to self-employment taxes. This can result in substantial tax savings. You also have liability protection. Like an LLC, an S-Corp provides limited liability protection, keeping your personal assets safe from business creditors. There's also pass-through taxation. Profits are directly passed through to shareholders and are taxed at the individual income tax rates, avoiding the double taxation that C-Corps or C-corporations face. Now, some cons. Complexity. S-Corps have more stringent operational requirements, including the need to adopt bylaws, hold regular director and shareholder meetings, and keep detailed records. There's also reasonable compensation requirements. The IRS closely scrutinizes S-Corp salaries. If they believe you're underpaying yourself to avoid taxes, you could face penalties. It's also limited to 100 shareholders. S-Corps cannot have more than 100 shareholders, which can limit growth opportunities. Now lastly, the heavy hitter. Finally, we come to the C-Corp, or C Corporation, the traditional business structure for large companies. If you're planning to scale your business, attract investors, or even go public, the C-Corp might be your best bet. Some pros: you have unlimited growth potential. A C-Corp can have an unlimited number of shareholders, making it easy to raise capital and attract investors. You have lower corporate tax rate. The flat corporate tax rate can be advantageous, especially with recent reductions in the corporate tax rate due to the Tax Cuts Jobs Act of 2017. You also have perpetual existence. A C-Corp continues to exist even if the owner leaves the company or sells their shares, providing stability. Now some cons. You have double taxation. Unlike pass-through entities, C-Corp's profits are taxed twice, once at the corporate level and again when dividends are distributed to shareholders. You also have complexity and costs. C-Corps require more rigorous compliance, including extensive record keeping, annual reports, and shareholder meetings. You also have limited flexibility in loss deduction. Shareholders cannot deduct business losses on their personal tax returns as they can with pass-through entities. Now, the QBI deduction sunset is something that we have to talk about. Why does this matter? As we approach 2026, there's another factor to consider, and that is the sunsetting of the QBI, which is a qualified business income deduction. Now, this deduction, which currently allows owners of pass-through entities like LLCs and S-Corps to deduct up to 20% of their business income, has been a significant tax savings tool. Once it expires, many business owners might find themselves facing higher tax bills, making it crucial to reassess their business structure now. So, what about making the right choice? Well, choosing the right business entity is not just a matter of paperwork. It's a strategic decision that can impact your taxes, liability, and growth potential. Whether you're a sole proprietor, LLC owner, S-Corp enthusiast, or C-Corp powerhouse, your choice should align with your business goals and financial strategy. As the tax landscape shifts in the coming years, particularly with the expiration of the QBI deduction, now is the time to act. Consult with your financial advisor or tax professional to ensure you're in the best position to protect your wealth and grow your business. I want to thank you all for tuning in if you made it this far, and remember, keep doing life and business better. Until next time, we'll see ya.